if you do not understand the US dollar, the US debt, and capital flow in the global market, you cannot properly underwrite multifamily deal in 2026. Now you'll be wondering, what is this all about? Isn't that just financials? What does that got to do with anything? This is not dramatic. It's simply maths. But if you really want to know how these different things I've mentioned could affect your 2026 underwriting for multifamily deal, watch to the end. Once again, my name is Bibi Ofiri. For those of you that do not know me, I am a multifamily investor and I teach people how to be financially free with multifamily. 5 years ago, cheap debt made everyone look smart. Refinancing could fix weak deals. Cap rate compression covered mistakes. And aggressive rent growth assumption felt very safe. 15%, 10%, 20%. Can you remember that? But today, the mask is off. 2026 is not a crash. Neither is it a comeback, but it is a reset. Because resets expose fragile strategies. So let's start with the dollar. Inflation has gradually reduced the purchasing power for some years now. That affects everything from insurance, labor, taxes, name it, housing, whatever it is you want to call it, it's affecting it. And it did not just start now, it's been for many years. But we get to your real estate can edge inflation. Yes, it can, but only if your income growth outpaces your expense growth and not the other way around. If your underwriting assumes that your rent growth solves everything, you are taking an invisible risk. Now let's move to another layer, which is the US national debt. I did a video last year about the US national debt. If you want to understand what that really looks like, go to my YouTube page and look for that. You understand what the US national debt is and how the growth is correctly affecting interest rate and even the US dollar. So as national debt increases, more treasury bonds are issued. So it means that when US borrows money, they issue out treasury bond in exchange. It's like a collateral. I give you my money, you give me treasury bond. That's what happens. And that requires more supply. So more supply requires a higher yield. So the more you need more money, the more I have the advantage to increase my interest rate. So I will only borrow you my money or loan you my money if your interest rate offer is attractive. So the more the US borrows money, the more whoever is borrowing them the money will take advantage of increasing their interest rate, and US will have to make it enticing for them to accept. So now that we know that, we can say that higher yields push borrowing costs higher across the economy, and that affects commercial lending directly. So if you're doing multifamily, this is a direct impact on how you acquire or how you sell a deal. So that's why I said you need to pay attention to this if you intend to underwrite deals in 2026. So what does higher borrowing costs really mean? Higher borrowing costs could mean lower valuation, wider cap rates, tighter refinancing proceeds, and less margin of error. And that's why refinancing and pre have stopped working. Cheap money was hiding very weak fundamentals. If we have to zoom out globally to see how this entire reset thing is working, we are now seeing a shift in the capital allocation. Monetary policies divergent. I'm not going to dig deep into it, so not to sound political, but I know that some of you understand what that means. And also a growing conversation about a long-term global order. But this is what matters to you as an investor. In an uncertain macroeconomic environment, capital moves towards durable income-producing assets. And you know what? Multifamily still qualifies because it's an income-producing asset. Housing demand is very real. It's on the high, and affordability challenges persist. It's really on the high right now. Renting is now becoming normalized. People can no longer afford to own their home. So renting has become very normal right now. So the opportunity has not disappeared, but the strategy has evolved. So what exactly have I been talking about regarding this topic, reset? What I'm trying to put a spotlight on is, at this point in time, your debt structure matters more than ever before. Business matters more, and cash flow, it's an undisputable must-have at this point. And there is more reason why your exit assumption must be very conservative, because appreciation is no more a guarantee, it's a promise. So what do? Be very conservative in underwriting, because this is no longer a market of aggressive optimism. It is a market of disciplined precision. And here's the truth that some people don't say. Macro forces do not destroy deals, but what can destroy a deal is weak underwriting. So if you cannot connect inflation projection in your underwriting, and if you cannot connect treasury to your exit cap assumption, and if you cannot stress test higher for longer debt, you are not underwriting, you're just hoping. And that's exactly why 2026 underwriting is not a technical skill. And I keep saying it. It is a survival skill. Whether you are a limited partner or you're a GP partner, it is a survival skill at this point in time. And your operators who win in these circles are the ones that think deeper, stress harder, and model smarter. This reset isn't punishment. It is purification. It's taking out the bad ones. It's separating the bad from the good, or the ones that are willing to do the job versus the one that just want to come in and go out. That is a get-rich-quick scheme. It's separating both. And precision will always win. So in other words, the market isn't broken, but the easy assumption is the reset is not here to scare you, but to sharpen you. Because in cycles like this, the winners are not the loudest, but they are the most disciplined ones. So if you can connect macro forces with macro decisions, if you can underwrite with clarity instead of hope, and if you can prioritize cash flow instead of fantasy, you won't just survive this reset, but you will perform it. Because in 2026, precision is power. So that's exactly why I built my multifamily mastery course, and I just had to, because I did it to help people understand how the macro forces can affect their macro decisions, to help them think deeper, smarter, and eliminate fragile assumptions before it costs them something. You don't have to go through the bad experience for you to learn. So if you're ready to stop hoping and you want to start knowing, join me on my underwriting mastery course. Very affordable. There are limited spots for the current price, and it's going to end by the end of February. Maybe I'll extend it to the end of March, but right now it's going to end at the end of February. And after the end of February, from the 1st of March, it's going to go up. So take advantage of it, and I will see you in my class. Bye-bye.